more than 6% right now, and Microsoft are all to the upside. 7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
$6.6 million Americans filed for unemployment last week. That's on top of the 3.3 million who filed the week before.
Just in case you've been wondering what this graph means, this graph represents the U.S. national debt and all the events that have driven the national debt to insane heights. As it stands today, the United States Treasury Department spends $2 billion daily to pay the interest on its existing debt. By 2033, that number will be closer to $4 billion. So if the interest on these debts are so excessive, why does the U.S. government keep borrowing money? Who is the U.S. indebted to? Last but probably the most important question, how does the national debt affect the American people? Over the last 2 decades, the U.S. has borrowed more and more money. As a comparison to the share of GDP, it's around 100%, the highest since the Second World War. The U.S. national debt just surpassed $34 trillion. Depending on when you watch this, it might already be more than that figure. Last year, more than $6 trillion were spent on different government programs, but that required taking on trillions in debt. Let's look at federal spending, including that debt, to get a clear picture of the economic situation. The U.S. government spends money on lots of things, like projects and services that help our country and people. But there's a catch. They also use money to pay interest on the debt we owe. As the debt gets bigger, so does the interest we have to pay. It's like a money domino effect. This relationship between growing debt and increasing interest adds a tricky element to how our economy works. Policymakers have to juggle these financial challenges carefully to keep things in balance. It's a bit like managing a budget at home, but on a much bigger scale for the whole country. So what did the government spend this money on? And how much came from revenue? And how much was borrowed? Imagine the government raking in a whopping $4 trillion. That's a whole lot of hard-earned cash from folks like you and me, thanks to income tax, corporate tax, and the trusty payroll tax. It's like hitting the jackpot, right? But here's the kicker. As we celebrate this financial fiesta, there's a catch. Turns out all those tax dollars, impressive as they may be, just can't cover the wild spending habits of our government. Now let's zoom into the spending spree, where the dollars aren't just cash, but characters in a lively play. Picture this, a grand stage where the government splurges on everything, from keeping Social Security and Medicare afloat to splashing out on military gear, fixing up our highways, putting up new buildings, fueling groundbreaking research, and even stuffing some cash into the education jar. In this complex world of government finances, every dollar plays a significant role in supporting various aspects of society.
I'm going to raise some taxes. Many of you are billionaires out there. You're going to stop paying at 3%.
Government spending is a critical part of our daily lives. The interaction between income and expenditures isn't just a routine. It's a fascinating dance of economic intricacies, where each financial decision contributes to the overall well-being of our nation. So, when you consider taxes, recognize them as a contribution to the ongoing financial balance that sustains the diverse elements of our society. And for the record, it's Congress and the President who decides how much money should be spent, where it should be spent, and how much taxes should be. The Treasury just handles the flow of money. So if the White House and Congress agree to spend $6 trillion, but only generate $4.4 trillion, whatever is left is known as a budget deficit. This is where debt comes in. The government then needs to borrow to finance programs and projects that it couldn't otherwise finance with its own generated revenue alone.
What's exactly happening here? Well, the U.S. government spends more money than it brings in, so it needs to borrow money to pay its bills. It can only borrow a certain amount of money, and if it needs to borrow more, well, Congress has to approve that.
In 2023, the federal government spent $1.7 trillion more than it generated from taxes. If you notice, the U.S. takes on more debt when the country spends a lot because of wars or investments needed during recessions and, most recently, pandemics. Here's what happens when the government needs to borrow more money for its economic agenda. First, Congress passes laws to determine spending and taxes. If the government spends so much that spending exceeds taxes, the Treasury must finance the deficit by borrowing and issuing Treasury bonds and bills. When Treasury issues issues a treasury bond or a treasury bill, this is basically an IOU. An investor gives the treasury some money with the expectation that they'll get the money back with interest. So generally, it works like this. You buy a $1,000 bond at a locked-in 2% interest rate for 30 years. Every year, the treasury sends you $20, the 2% interest you've earned. And after 30 years, you can cash out the bond and get your $1,000 back. It's a win-win situation. The US gets money to fund the government, and you make some profit on a safe investment. At the end of December 2023, when the debt was about $100 billion less, the majority of the debt, about $25.7 trillion, was held by the public. Of that amount, more than half of those bonds are owned by Americans and American companies. Investors and also banks, local governments, and even pension funds keep their money in bonds. Foreign investors only own a quarter of the total US debt. And while Chinese investors used to have the largest share, Japanese investors own more now. They own around 4% of all US debt, and it is a lot of debt. But ironically, the largest part is owned by the federal government. Yes, the federal government owns part of the federal government's debt. Roughly $7 trillion of the US debt is intragovernmental debt holdings, meaning the government owes itself that money. The money for Social Security is actually kept in bonds. So is the money for Medicare and federal pensions. The Federal Reserve has bonds too. Of all the developed countries, the US has the fourth largest debt compared to the size of the economy. So is this bad?
A really, really frustrating answer is we don't know.
Debt has pros and cons. One question is, what are you doing with the debt?
How does it affect the American people? Looking ahead, debt will continue to skyrocket as the Treasury expects to borrow nearly $1 trillion more by the end of March, said Peterson Foundation CEO Michael Peterson. The current debt equates to about $100,000 per person in the US. Adding trillion after trillion in debt year after year should be a flashing red warning sign. The worst case scenario would be if Congress doesn't raise the debt ceiling and the US default on its interest payments, or is unable to pay investors on time. Then the US bonds would be proven unsafe investments. Investors would demand higher interest rates for their higher risk, and that would raise interest rates for everyone. When there's little confidence that the benchmark itself is going to be paid off, it creates uncertainty in financial markets. When there's financial uncertainty, very often companies lay people off. So everybody has a stake in this. Digging into the details, an analysis by Moody's delves into the potential outcomes of various scenarios related to the US debt situation. If, in the event of a brief default, the Treasury opts to prioritize paying investors over crucial commitments like senior Social Security or Medicare, the outcome could be a fragile economy slipping into a mild recession, marked by the loss of nearly 1 million jobs. However, the stakes rise considerably if a default persists for weeks or months, and interest payments to investors are neglected. This prolonged financial turmoil could echo the severity of the 2008 economic meltdown, resulting in the loss of over 7 million jobs and a staggering depletion of $10 trillion in household wealth. The economic landscape would resemble a storm, with widespread repercussions impacting employment and financial stability. To steer clear of these ominous scenarios, a crucial piece of the puzzle lies in the agreement between the House, Senate, and White House to consistently raise the debt ceiling when required. This isn't just a bureaucratic ritual, it's a vital measure to uphold the economic resilience of the nation, safeguarding jobs, household wealth, and overall financial stability. The intricate dance of financial decisions at the highest levels of government plays a pivotal role in determining the economic well-being of millions.